in for the long haul. Income investors in particular need to pay attention. For long-term income to be sustainable, it obviously needs to be protected from the erosive power of inflation. So with that in mind, I'm delighted to be joined today by Baillie Gifford's Stephen Hay, a product specialist on their multi-asset income fund, who will shed some light on the challenges that the onset of inflation brings to income investors, and also offer us some insight into how Baillie Gifford are trying to rise to that challenge. Throughout this webinar, do feel free to put any and all of your questions to Stephen using the chat function, which you'll find at the bottom of your screen. And if you wish to remain anonymous, then simply select my name from a drop-down list in the chat box before you type your message. That way only I can see it. So just before I hand over to Stephen, let me quickly run through our learning objectives for today's session. They are to explain the reasons inflation may be higher for a sustained period, describe which investments can provide income growth to combat inflation, and explain the benefits of a global multi-asset approach to deliver reliable long-term income. So that's the CPD covered. Now, before I hand over to Stephen Hay from Baillie Gifford, please take part in the first poll of our session today, which should be appearing on your screens now. The first poll is, where do you think UK inflation will average over the next 10 years? Please put in your answers, either A, 0 to 2%, B, 2 to 4%, or C, more than 4%. If you submit your answers now, we'll reveal the results in about 15 seconds or so. Lovely. Do we have the results? There we are. Wow, okay. 86% of you say 2 to 4%. So that's a pretty confident vote from you all. So with that in mind, I'll hand over to Stephen for the first part of his presentation. Take it away, Stephen.
Thanks very much, Tom, and afternoon, everybody. That poll wasn't a huge surprise to me, but my view is a bit different to where that came out. So we'll see maybe if we're to do a poll later, I wonder how different it would be. I mean, you're absolutely right, Tom. Inflation is such an important topic. It's a significant risk to investment returns. A prolonged spell of inflation can really profoundly dent the purchasing power of our income. And for a long-term income to be sustainable, it needs to be inflation-proof. So we spend a lot of time thinking about it as we know how much it impacts on our clients. I'm just going to share my screen quickly. So, I mean, it's no surprise to anyone that we know that current inflation is really quite high. This chart here is for the US, but you could really repeat this for most countries in the world. What this chart shows is the typical path for inflation over the year, over a 20-year period. So, you know, the median path for inflation typically ends up around about 2. At the highest point shown in the brown line or so, maybe up to about 3%. And you can see that the path for 2021 was just off the scale compared to what we've seen previously for core US inflation. So there's clearly something quite different going on with inflation than we've seen in at least the recent past, the last decade or two, when we've really become very used to inflation being low and very well controlled. So I was going to talk first of all about the cyclical aspect of what's happening with inflation, and then move on to some of the structural factors that are also influencing the path of inflation, not just in the next year or two, but in the longer term. Now, I think clearly what's going on at the moment is influenced by COVID and the response to that. So in particular, we've seen supply chains really significantly affected by what's happened with the restrictions that have been in place, and that's clearly causing a number of bottlenecks in terms of the supply chain, and that's causing prices to go up. Used cars, for example, were one very good example of that last year, which were, you know, a large chunk of the US inflation last year was used car prices going up, and that's at least partly because not as many new cars are being produced because of the chip shortages. So That's a great example of a temporary supply disruption that's caused inflation to push up. But I think that's only part of the story. The next chart tells you a bit more about the government's response to this. So, we've seen the COVID restrictions, but the government response has really been quite dramatic. So this is a chart for the UK economy, and what happens when you go into a recession? Typically, economic growth falls below what we call potential growth, where it would be in normal circumstances. So economic growth falls right down relative to potential. That's what economists call an output gap. And that's what was shown here in the black line. And this goes back to include the great financial crisis as well. So, and typically what happens when there's a big output gap, when economic growth falls, is the government eases significantly to try and boost economic growth up. And that's exactly what you saw during the global financial crisis. You saw a big fall in economic growth relative to potential, and then you saw a big fiscal stimulus. That's what we're showing in the brown line. This is the amount of additional government spending coming into the economy. And as you can see, it was a big increase in the fiscal spending, but it was appropriate for the level of economic growth had fallen to. Now, if you look forward to COVID-19 and the impact, you can see that actually the impact on economic growth relative potential wasn't that big compared to the global financial crisis. And that's because the demand side of the economy collapsed, but the supply side of the economy also contracted a lot because of all these restrictions in place. So actually, there wasn't that huge need for a lot of government spending to come in to boost the economy from a demand-supply perspective. But yet, look at the fiscal response from the government. It was of a scale even bigger than during the global financial crisis. So what they've done is they've thrown policy stimulus at an economy that didn't actually need it from a demand and supply point of view. And to add to that, we've had a huge amount of monetary easing as well. So interest rates have been on the floor, and there's a large amount of quantitative easing, over almost 500 billion since COVID-19 hit. And that's all liquidity that's sloshing around the system looking for a home to find, and it's largely finding its way into the price of everything. So we're seeing a cyclical inflationary dynamic, which is the strongest that I can remember for many, many years, and one that I think is likely to light the fuse on longer term inflation expectations. But people will push back against this argument and say, well, but this is temporary, the supply side disruptions and this policy stimulus, which is gradually being withdrawn. These are temporary phenomena. And so this inflation spike that we're seeing at the moment, that'll pass, and inflation will fall back down to the kind of levels it's been at before. Now, this is where you have to look at the structural side of the story and think about those longer term influences on inflation. And there's three key structural factors that have been really, really important in holding inflation down for the last 20 to 30 years. And really these forces work through wages. The labour market is key here. We can't get a sustained period of high inflation unless we see wages growing. You can't miss it in the news at the moment that people's wages are not keeping up with inflation. What we call real wages are actually falling. And it's only if people are able to bargain for higher wages that we can see inflation start to really pick up in a longer time period. So of those three factors that I was mentioning, the first one is globalization. So globalization has been super important for the UK economy and others to keep inflation low, to keep wages under control for the last several decades. The outsourcing of manufacturing to emerging markets, a greater share of our goods are imported. All of these things have been really helpful for keeping inflation low. And you can see from this chart that for a long period from from the early 80s, indeed, for about over 2 decades, globalization was increasing. Now, this globalization is a hard concept to measure, but this is one way of measuring it. It's a measure of exports as a share of GDP. And you can see they were rising consistently for 2 to 3 decades. But it now looks like globalization has peaked, and it may even have gone into reverse. And I think thinking about the reasons for this, one big reason is looking back at over the last 3 or 4 decades, there was the integration of China and the ex-Soviet Union into the global trading system, which was a huge, big one-off increase in global trade and the globalization, if you like. And that won't be repeated. And there are also various other reasons that we're seeing. So the political situation, the political environment for outsourcing is a little bit less conducive than it maybe has been in the past. Think of China and the US and the political tensions there. And I think another really important thing is that economies are looking to bring their supply chains more localized. The COVID pandemic has given them reason to want to bring their supply chains shorter, closer to home, to make them more reliable. And another huge factor here is companies and countries wanting to make their supply chains more sustainable. And that often means making them shorter so that they're not the transportation of goods or services to the same degree. So the localization of our economies, I think, is a theme that will develop for quite some time. So in my view, globalization, which has been a hugely important factor keeping inflation low in developed markets such as the UK, I think that's not going to be such an important factor going forward. I'm not saying it's massively going into reverse, but I think it's not going to push on in the same way that it did before. Now, the second key point is structural factor is demographics. So demographics for many years have been very helpful in keeping wages low. But what this chart shows is the percentage of the population that is of working age. So in the grey line, we have the advanced economies. And the advanced economies, for some time, there hasn't been much growth in the working age population share. And you can see indeed that it started to fall. But that hasn't mattered because the growth of the working age population in the emerging world, shown in the blue line, has really been quite strong over the last 2 to 3 decades. And at a global level, shown in the red line, that's more than made up for the advanced economy. So globally, we've had a growing working age share of the population. So more workers, and that's meant that hasn't put upward pressure on wages. It's a downward pressure on wages because the supply of workers has been quite plentiful. But as you can see now, in advanced economies, it's turning negative. And at the world levels as a whole, we are also beginning to turn negative. So we are now getting less working age population share of the economies. And that, I think, is likely to put upward pressure on wages globally. Now, it'll be a slow moving factor, but from a factor that has been very important for keeping wages low, I think it's turned around and it's now facing the other direction. Now, in terms of the third big factor, this one is automation or technology. So the advances in automation, think about the internet in terms of price transparency or the ability to outsource certain jobs, work from home, all these things have been very important for keeping inflation low, that technological disruption. Now, this is one factor that I have some different views from my colleagues. Some of them are actually thinking this factor technology could be accelerating from here and the disruption might be even greater, and that will be a force keeping inflation low. I'm not convinced by that. I think technology will continue to be an important factor, which is disinflationary. It's something that does help to keep prices down, as it always has. I'm just not convinced that it's going to accelerate from here. So for me, technology is still there, but it's not changing its impact dramatically. And to me, I think some people overestimate the ability for machines to replace labor. I don't think always that machines can very quickly do human jobs. Of course, it's coming, but it's coming slowly. And I don't think it's coming fast enough to affect our inflation view over the next several years. So to sum up, we've got a very strong cyclical inflationary dynamic at the moment. And that's partly because of the supply side restricted demand, but it's also because of the government's stimulus on both the fiscal and the monetary side has been outsized relative to what it needed to do. And then in the three big structural factors, on the globalization, we have stalled and probably get into reverse. On demographics, so it's been a definite tailwind for low inflation, has turned around the other way and is now pushing towards higher inflation. And on technology, it's still there as a factor, but I think it's a relatively small deal for inflation. So I'm going to stop there and hand back to Tom.
Thanks for that, Stephen. So as I gather, your view is that we will see higher inflation, but do you not think banks can manage any increase in inflation, or do you think kind of post QE they're running out of tools to do so?
Yeah, that's a really good point, Tom. So, and it's a point that's made by a lot of people. So they say, okay, so inflation might be a little bit higher, but surely central banks have inflation targets. You know, we've come to believe that they're credible. They've hit their inflation targets consistently over many years. So why should we not believe that they'll do that again and they'll tighten policy as appropriate? Indeed, you have seen some beginnings of central banks talking a little bit more hawkishly. Well, I mean, I think central banks certainly know how to control inflation from a mechanical perspective. I think the incentives for them are changing, and I think there are a few reasons why they're going to find it a bit more difficult to control inflation than they've had in the past. Firstly, I think it's easy to tighten policy, you know, raising interest rates and tapering quantitative easing if the economy is growing fast. But it's actually much harder if growth is faltering, financial markets are wavering, but yet inflation is still high and sticky. You know, we're in the middle of a strong recovery at the moment, so it's relatively easy for them to start to tighten now, but it's going to be much harder when they get to a situation where it involves tightening into a slowing economy. And remember, there's going to be a lot of incentives to keep the growth going to get us safely out of the pandemic, and I think the political pressure on them not to tighten into that will be quite strong. Secondly, I think governments have largely thrown fiscal discipline out of the window through the global financial crisis and latterly through the response to the pandemic. I mean, in some ways, understandably, but I think that the climate emergency from here demands even further spending on infrastructure. They're kind of existential threats to our way of life, and they demand large government responses. But what you've got now is a very high level of UK debt. So it's now in fact, so high that a 1% increase in interest rates costs around 20 billion in additional interest costs every year, which is over 40 new hospitals. So that just puts into context the challenge that the central bank will have when it's tightening. I think the government's incentives here have changed quite dramatically from the past, when they were definitely in favor of lower inflation, you know, back 20 years ago. And I think that's changed now. And thirdly, broadening that point out, I'm just not sure we have the same consensus in society for low inflation anymore. You know, we have generations that have only known inflation to be too low, and that's been the problem rather than inflation being too high. So, you know, I think the younger generation especially, but maybe more than just that, care more about climate change and inequality than they do about whether inflation is 2% or 4%. So I think there's a number of reasons why the incentives behind the key institutions that will decide what inflation is have changed. After the 70s, there was a clear mandate to bring inflation down. I think that mandate has weakened and weakened and weakened, and I think it's actually maybe even the other way now, that people, you know, want to inflate away the debt as one of their key things. And you're getting some really mixed messages from central banks. And I think you have to be very wary about believing what they tell you. And we've seen the US Federal Reserve change its inflation target to an average inflation targeting regime now, which means that they can accommodate periods of higher inflation, which they'll tell you will then have periods of lower inflation to compensate, but it gives them a lot of leeway to have higher inflation for a period without having to do anything about it. So, you know, those cyclical factors, the structural forces, and a change stroke weakened policy response is why, for me, we've got a greater chance now of a sustained period of high inflation than we've had for the last 30 years.
And have you been surprised by how slowly banks have reacted with interest rate rises since we've seen, some significant inflation over the last few months?
Not really, no. I think we're beginning to see some more hawkish rhetoric come out of the central banks, and the interest rate markets are now pricing in some tightening starting this year. So maybe 3 to 4 hikes from the Fed this year. I think that's kind of to be expected. And at the moment, I think the jury is still out. I mean, when I discuss with my colleagues about my views on the central banks, they will say, but look, they're beginning to tighten. What would you expect? They wouldn't expect to tighten, right in the middle of the pandemic. They're going to leave it for a bit and tighten. And so, it's not clear yet how much they will tighten. And I'm giving you my view that I think they will err on the side of not tightening enough. I think politically it'll be too difficult. But I do have colleagues that think, well, we're still in the same regime, and they will tighten by enough. And the noises we've heard from them so far would back up their view.
You mentioned your colleagues there. You've got differing opinions within Baillie Gifford. How is Baillie Gifford as a fund house in general reacting to higher inflation?
Well, the first thing I should say is these views today are they're my views. Baillie Gifford as an investment manager doesn't have any house views on inflation. We very much look at the bottom up, and we'll certainly be known for finding companies that can do well and under what we hope it to be a variety of economic situations. But it is something that's being discussed. Lots of different views there. As I said, some people will definitely put more weight on technology as a factor that can bring down inflation, and the fact that that's perhaps accelerating in terms of its impact. And certainly from my US equity colleagues, they will say that they're seeing more disruption now across a variety of industries than they've ever seen, and that disruption would typically be associated with prices coming down. So that's the disruptors coming in and doing something more efficiently. So that's definitely an argument that has some people will hold to. Other people are less persuaded by the globalization arguments. They think it's going to still remain a very strong force. I happen to think that the sustainability agenda is really important, and that transition to a green economy will push prices up. So there's a variety of views. I think what we, as well as debating the broad macro outlook, there's certainly been a lot of time spent thinking about how individual investments can do under a higher inflation scenario. So, we're certainly making sure that we've thought about that for all our investments. What is their ability to cope with the higher inflation?
And just before we move on to the next part of your presentation, Matthew Broadhurst in the chat has asked, RPI has gone 7.5%. Do you think it will break double figures? And I suppose rather than asking for you to forecast specific figures, I guess that kind of a different similar question is: do you think inflation will go significantly, stay significantly at a significantly high rate going forward?
Yeah, that's a really good point. I should maybe have mentioned that earlier. So when I'm talking about a higher inflation here, I'm not talking about double-digit inflation. I don't rule that out as a possibility at some point, but to my mind, it's just a level of inflation that's a significant bit above where it's been in the last couple of decades. So when I answered that poll, I was trying to bias the number upwards. I was saying above 4 in the UK. So it would be, my central expectation was we will see inflation, at least at 4%, on average over the next 10 years. So the window that I think is perhaps most relevant for us right now is actually the historical period in the UK from the late 60s to the early 70s, before the big oil price shock and inflation went to double digits. So we saw inflation just gradually move up over a period of three to 4 years. And I think that's something that's quite plausible here, that there are there are still things that are holding inflation back. There's a lot of inertia in the system. And I think it would be unlikely we would see it suddenly accelerate into double-digit inflation. That's a kind of one possibility, but I don't think that's going to happen. But I think we could easily see sustained inflation in the 4 to 5% range, which is really enough to make a significant difference to investment returns from different asset classes.
Okay, before we move on to the next part of the presentation and get our second poll out of the session, for those of you who haven't got your last names, for viewers, if you haven't got your last names in the Zoom chat, or sorry, on your Zoom window, we can't give you your CPD because we don't quite know who you are because you haven't got your last name. So if you click on your box and scroll down to rename and put your first and last name in there, then we can make sure you get your CPD, and that'd be great, thank you. Now, if we can get our second poll up, and I believe last poll up of this webinar, there we go. It says, which asset class do you think provides the best hedge against inflation? A, equities, B, property, C, gold, or D, Bitcoin? We'll just let that run for 10 more seconds. And then we'll see the results, and I'll pass back over to Stephen for the second part of his presentation. Let's see the results of the poll if we can, please. Lovely, there you go. 79% equities, 11% of property, 10% gold. Stephen, I'll leave you with that information and for you to get on the second part of your presentation today.
Great, thanks, Tom. Yeah, interesting poll results actually. I'll maybe come back to my answer to that in a wee while at the end of the section, and keep people waiting a little bit to see what I think the answer to that one is. I'll just share my screen again. So, I mean, just thinking about which investments can do well against inflation, it may sound obvious, but I think the main aim should be to look for investments that have an inflation linkage, although that might be implicit as much as explicit, and that's where a little bit more consideration is required. If I start at a high level, our multi-asset income fund is designed to appeal to clients who want that core income investment they can rely on over time. But as you can see in the first box, we have a specific objective to provide investment returns in real terms. So that is to grow income and capital in line with inflation. So that's something that we've always recognized, even before this current inflation concern. It's something we've always recognized is absolutely crucially important to people who are looking to have a reliable, sustainable income stream over their retirement, for example, certainly over long periods. So I think that explicit objective should give you at least some confidence that as fund managers, we do care about inflation and its impact on the outcomes the fund provides for our clients. And we do spend a lot of time thinking about it. So if we delve a little bit more into it, there are certain investments with explicit inflation linkages. You can think about index-linked bonds, for example, which provide you with a negative real yield at the moment, but they will have an explicit linkage to protect you against inflation. But often we have to consider what kind of implicit linkages there are in different asset classes. Now, if we look at the broad asset classes, then typically for bonds, we don't have that linkage with the inflation, and the income you receive is eroded by inflation over time. And this is something we're very aware of even before the current inflation concern. So I've got a chart here, which is I think is really quite helpful to think about it, but this is illustrative. And what we're showing in this chart here is the amount of income you get from 3 different asset classes. So high yield bonds, equity, and then an amalgam of property and infrastructure, which we call real assets. So in the yellow line, as you can see, for high yield bonds, we have a high initial income. Now, what we're showing here is not the yield. We are showing the income progression, so the amount of pounds we get every year from these different asset classes. So as you can see, in year 1, it's high yield bonds that give you the highest amount of income per 100 invested, and it's equities that give you the lowest, not surprisingly. So we all broadly speaking know this, and infrastructure and property sit somewhere in the middle. And these yields are not far off where we are at the moment in the market. But the really interesting thing is moving this forward in time. And this is something we are very, very aware of because of the long-term nature of the way we invest. But as you can see, that we've made some very basic assumptions here. We've actually assumed inflation only at 2% for the purpose of this. And we've made some assumptions for equity growth and for high yield defaults, which are just standard assumptions that we have within our general modeling. But as you can see, the income from equities does increase over time in real terms, whereas the income from bonds falls away, really quite significantly, certainly over a 10-year period, which is about the crossing point there. It falls down below equities. So, I mean, this is a really important point, and it's one reason why you shouldn't be too attracted in terms of thinking about your long-term income. You don't want to be too attracted by a very high short-term yield coming from, say, the high-yield bond market, because that will look good in year one. But if you hold those assets, then over time they will produce a smaller and smaller part of your lower income, and so you need to make sure you're very aware of that. Now, these are broad asset class characteristics, and of course, there's huge variability within each asset class, and certainly not all equities were created equal in this regard. And this next example here shows you how it's important to focus on that long-term income progression and not be lulled in by the fallacy of high short-term yields. So Microsoft is a great example of what this looks like in practice. Having tackled its competitive threats with strong cloud-based offering, is in a very strong position to generate significant cash flows, which has supported a very strong long-term dividend progression. Now, the challenge for some income investors is that these companies often don't offer the highest current yield. So if we go back 10 years, the start of this, where the chart starts, Microsoft yielded only around 2%, shown here in the blue bars. Now, if we compare this to RWE, which was a German utility, it was seen as a blue chip income investment at that time. It yielded around 7%. But you can see the folly in trusting in that high yield. When analysed properly, it was apparent that RWE was powered by dirty coal and nuclear with lots and lots of debt on its balance sheet. Regulatory changes quickly put paid to the free cash flow or what looked like the free cash flow, as it was forced to reinvest in clean energy. And no surprise to us, it had cut its dividend as a result. Meanwhile, Microsoft has been steadily growing its dividend. So you now get around $7 for every $100 you invested 10 years ago. And the total income return of Microsoft has been double that of RWE over the period, with the added bonus that there's been a significant capital return for our clients who've benefited from investing in Microsoft at that time. So, I mean, this is a particular example, but it does illustrate the importance of picking companies that can really grow their income over the longer term. And so to select a portfolio of equities that can help protect against inflation, we need to identify those companies with pricing power or the potential for volume growth so that the earnings and the dividends can grow ahead of inflation. And to do this, we think you need to look ahead, look to the future, how the world's changing, and apply the mindset that I think Baillie Gifford is fairly synonymous with, which is thinking about what are the companies of tomorrow. Now, I'm just going to show you some examples of what we've found around the world. So it's not just in equities. But if we look at the likes of Kering and Silicon Motion, two of our equities. Kering is a manufacturer of luxury goods. There's a lot of brand loyalty, and therefore there's a lot of pricing power. And we think it's a good, steady, long-term compounder. One of its biggest divisions, Gucci, was underperforming. We did some independent research work on it, on the turnaround prospects, and that's worked out extremely well, and we're confident in this holding. Silicon Motion is a Taiwanese company. It's a world leader. It's a fairly niche position, but it makes controllers for memory chips. But it's grown its earnings doubled its earnings in the space of 2 years. So this is an example of a company that's really achieving growth, and although it has been low yielding, it's growing its income very fast. But there are other examples, not just in equities. So if we look at infrastructure and we look at WEC Energy, and we have to be very careful about which securities we select. RWE would give you that cautionary tale, but WEC is a good contrasting example. It's one of the largest energy generators and distributors in the US, based in Wisconsin, and it's on the right side of the green energy transition. It's significantly reduced its coal capacity, and it's reinvesting the cost savings into renewables. And crucially for us, it's got a very supportive regulator, one of the most generous in the US, which understands the balance between keeping the lights on today, but also investing in the transition to green energy. So as a result, it can generate a return on equity close to 10%, which is very supportive of its dividend. In property, I'll give you a property example. So CTP, one of the REITs that we really like, it's one of the largest owners of logistics and industrial properties in Central and Eastern Europe. And this is a real growth area, this logistics property. And there's very high barriers to entry in this region. And CTP is a very well placed place in terms of market share. So it's got a yield of 2.5, but we think it's got the potential to double its dividend in the next 5 years. Now, bonds, as I said before, that bonds don't naturally protect you against inflation. So it's very important to think about the actual individual investment case. We've shown on the chart Indonesia. Indonesia is a very well managed emerging market. Its bonds currently yield about 7%, and its inflation is less than 2%, which is kind of the other way around from the UK and the US, which is the way you want it to be. So it's got a 5% real yield cushion. So that's something that is attractive and gives you a big cushion if inflation were to move up. And Netflix, I mean, a company familiar to us all. Now, when we first started looking at Netflix in 2017, it relied very heavily on the bond market for funding. It consumed more than $3 billion a year in cash to invest in original content. So, and for many short-term bond investors, people thought it was high risk because of the negative cash flow. And we felt quite differently. We liked the equity, have held the equity. And our long-term view was that Netflix had a strong and enduring competitive advantage that would put it in a good position to generate positive cash flow in the future, which it's since achieved. And its bonds have delivered both income, very good income, and capital appreciation. So even with the challenges of higher inflation, there are bonds that you can find, that you can pick, that have a very good story behind them, and that can help at least offset the challenges of higher inflation. So in terms of what we're doing, we're making sure we're in the right asset classes, and within each asset class, we're making sure the investment is robust to higher inflation. Now, I promised you I would come back to the poll question. So very briefly, we looked at a number of inflation periods to look at which asset classes had given the best returns. And if I go back to that UK period again, from the late 60s to the early 70s, just before the really high inflation, then actually property does pretty well. So property kept pace with equities over most of that period. Bonds, as everyone would expect, give you a negative real return. Property and equities were the best. Gold did quite well, but didn't do as well as property or equities during most of that period. I put in Bitcoin, which obviously we don't have much historical data on that, but it's always an interesting one. And there's certainly been some speculation that Bitcoin, could be the new gold, if you like. And there's certainly an argument that Bitcoin does have some inflation protecting qualities in terms of the supply being limited at a time when fiat currencies are probably going to be devalued in real terms because of all the money printing. There is some attraction to Bitcoin. It's not an area of investment that we have invested in the fund. There's too much speculation, too much uncertainty, and not enough clarity on what you're actually investing for us to have invested in Bitcoin. But it's certainly an interesting one when we think about assets that naturally protect against inflation. There is an argument to be made there. I shall stop there, Tom.
Thanks for that, Stephen. Just thinking about your slide that had the income opportunities on it. You had the globe with a few different companies and bonds. Would you say that diversification is your toughest task at the moment as a multi-asset income manager, or would you say as an income manager, you've got a fair amount of options there instead of perhaps a growth fund or a value fund?
Certainly, having the options is very, very important to us, Tom. So I'll maybe just share my screen for a moment again. So I mean, for us, it's very important to have that diversification to help with the resilience and reliability of our income. So we invest in 9 broad asset classes, which for simplicity can be categorized in 3 ways: the equities, which provide real growth in income and capital; the real assets, such as infrastructure and property, which have got particularly attractive characteristics for a long-term income portfolio and should protect against.
Sorry, Stephen, are you meant to be showing your screen? It's not coming up. I don't believe, or not on my screen anyway. Yeah, there you go. It's up.
Okay. I was just explaining about the 9 different asset classes, the 3 broad types of assets that we can invest in, and I mean that broad opportunity set really does provide the benefits in terms of diversification for both income and capital, and also gives us a lot of flexibility to asset allocate to deal with different economic scenarios over time. We know we did before we launched the strategy over 3 years ago now. We did a lot of modeling of the income characteristics of all these different asset classes, and it's really interesting to see it. It looks like a bit of a spaghetti chart when you plot the income for the different asset classes. So what you often see is that the income from the likes of equities or property can be quite highly correlated. So you see dividend cuts at the same time, but what you see is the infrastructure, for example, tends to be in quite a different cycle. So you just don't see the dividend cuts at the same time. Often it's regulatory risk there that can come in and affect the dividends. And then the bonds are on quite a different cycle. So even companies in high yield that may suffer during an economic downturn, you tend to see the drop in income, a year or 2 after you've seen it in the property or the equities. So that diversification really does help you with providing a reliable income and making sure it's nice and stable. And then we've got the asset allocation options between the different asset classes. So to take advantage of when different asset classes look rich or expensive, or if we have a particular view of the economic future.
You mentioned the infrastructure opportunity for income. How important is the sustainability, or to put it in a general term, the greenness of a bond or an infrastructure investment going forward? Are all of your investments there in to be broad green?
It's an area that you picked on probably one of the most important issues for us going forward, and which is really to think about the sustainability. It's a key part of our investment decision now to look at an infrastructure fund or a company's business, look at the existing carbon emissions, look at other aspects of the sustainability of the business, and then look at what their plans are going forward. Because we do know that power generation and carbon emissions are part of our present, and we need to transition to a future that has much lower carbon emissions and is much more sustainable. And we do think we should be part of that transition. So it's very important to us that we do provide capital to the companies that are doing the right thing. And so a lot of our research and discussion and engagement with companies is to establish that they are doing the right thing. Do they have plans to reduce their emissions? Are they a leader within their field, within their industry? And do we have faith in that? So we have to see their milestones. We have to monitor them, engage with them if we see them not hitting them, and ultimately sell them if they're not doing as they say they're going to do. But I don't think it's not the easiest area of investment in infrastructure, because there are, the infrastructure part of the portfolio does have more carbon emissions than most other areas of the portfolio, and so we're looking to see that come down. I should say that we are already in a reasonably good position. We have our emissions relative to a representative index across all the different asset classes is substantially below that index. So we're 1/2 to 2/3 of the index level emissions. So we're already doing what we think is quite a good job, but it's still a challenging one going forward to make sure that we are investing in companies that are sustainable, because ultimately those are the ones that will be successful. And so we're absolutely aligned with that.
We've got a couple more minutes before we need to jump into the Q&A properly. So I'll leave you to do the last couple of slides of your presentation.
Okay, thanks, Tom. Yeah, just one slide left really. So that was just to give a flavour of our current positioning and what we're thinking about. So as I was saying before, we have those 3 broad asset classes, and our strategic asset allocation, if you like, is round about 1/3 in fixed income, 1/3 in equities, and 1/3 in real assets, those property and infrastructure names. So that's what we've modelled as the type of split within the portfolio that would achieve our objectives. Now, obviously, within those broad categories, there's quite a lot within there. So within fixed income, for example, we have the range of different bond asset classes. So the developed market governments, investment grade credit, high yield credit, and emerging market, both local and hard currency. So quite a lot of variety within fixed income. But just to give you a flavour of what we're doing, of what we're at the moment. So we have a lower weight in fixed income than we've had in the past, and lower than our strategic weight. So recognizing that there's not a lot of attractiveness for an income investor in developed market sovereign bonds, or indeed in the investment grade corporate bonds, where yields are really just too low, and we see the direction of travel for yields as to continue rising. So next to nothing in the portfolio in those 2 asset classes. And within fixed income, we do have some allocation to EM bonds, which, as I mentioned earlier with the Indonesia example, you have more protection against inflation because you have that higher yield. And in high yield itself, we think high yields that can actually do reasonably well with an inflation scenario, provided inflation is not too high. You have the spread relative to government bonds, so you're earning that. Plus, the high yield tends to be quite short maturity, quite short duration bonds, so they tend to roll over quite quickly, and so you don't see the same degree of capital loss if yields rise. And actually, a bit of inflation is quite good for high yield bonds or high yield companies, because these are typically higher indebted companies. Provided interest rates don't rise too much, a bit of inflation, and that's the environment we see going forward. One of higher inflation, but not enough policy action in terms of rates, that could actually be really quite good for high yield bonds. So high yield bonds is our largest allocation within the bond portfolio. I should also mention that we are able to hedge in this portfolio using some derivatives. So we've hedged a large bit of our duration exposure. So our exposure to rising yields has been largely partly by being underweight fixed income, but also by using derivatives to hedge that risk, and that's been helpful over the last year. In terms of overweights, infrastructure continues to be one of our favoured areas, and that's an overweight relative to our strategic weight. Our analyst Nicoletta is extremely positive on the green transition and the opportunities there. So we've got a number of renewable funds in that part of the portfolio, and a number of infrastructure in pipelines and various other infrastructure of energy, which will really benefit from the green transition and lots of investment. So lots of capacity to increase volumes and return on equity in that area of the fund. So infrastructure we like. Property we also like, finding lots of nice examples in property. And just also mentioned we have some holdings in gold through gold equities. That's our proxy for gold. and we think gold miners can be quite a nice hedge in the portfolio. Certainly a hedge for higher inflation, but also a hedge when things don't go so well in the world. So I recognise that we don't have a lot of what you might class as being the kind of traditional safe assets, the likes of gilts or US Treasuries, or things that hold in when the world collapses, and we just don't like them. Therefore, we don't want to hold them. But we know that gold should do well in a significant risk-off environment. So that's that we have some gold equities in the portfolio. So I think just to sum up our overall approach, what we're really watching here very closely is what's happening to real yields. So what we've seen over the last year or so is that nominal yields in the market, bond yields that you see in gilts and treasuries, have been rising, but inflation and inflation expectations have also been rising. So in real terms, those yields haven't been going up. And so that's still a very supportive environment for equities and other real assets like property and infrastructure. So that's where we are. We are thinking those types of assets will continue to do well. If we're wrong and we see the central banks tighten aggressively and really bring inflation down, then we have plenty of options within the fund to begin to overweight some fixed income again, which I think is really one of the really nice things about the multi-asset approach to income, which I think is I guess much more sustainable than a simple equity approach or a simple bond approach to income. We do have those options that we can move the portfolio about depending on the economic environment.
Lovely, thank you, Stephen. We've got a few minutes for Q&A, so I'll throw some questions over to you now before we finish up. We have only got a few minutes to try and keep your answers semi-quick, but obviously offer as much detail as you can within a quick time and do them justice. We've had a number of questions to the effect of some Baillie Gifford funds haven't performed too well over the last 6 months, obviously after a pretty good run before that. I suppose a number of people want to know, is there any plan to change? What reactions are happening at Baillie Gifford to try and reverse their fortunes?
There's been no change at all, Tom. I mean, we just focus on finding the companies that we think are going to be disrupting and the ones that can grow the most in the world that we see, whether it be in innovation in healthcare, a whole bunch of different areas. There's been absolutely no change to the way we go about investing, and there won't be. We'll continue to do that. But of course, the market sometimes favors other types of stocks, and we've certainly seen technology and other what might be classed as growth stocks take a little bit of a hit after an extremely strong multi-year performance. So no, short answer is we're not changing anything.
And a bit of a throwback towards the beginning of the presentation. Someone asked how many rate hikes are currently priced into equity markets. If 3 to 4 hikes do materialize this year, Stephen, I believe that's what you said, you expected from the Fed earlier on in your presentation. Do we expect multiples to keep contracting until the rate hikes are announced, or have the recent sell-offs largely priced in expectations for this year?
Well, it shouldn't be a secret to anybody that 3 to 4 rate hikes is priced in. The equity market should be very well aware of that. So it's your best guess as mine, Tom, in terms of exactly how things respond in the near term. But I think the equity market is aware that the interest rates will probably be going up. But then you put against that, I think there'll be really good earnings growth. So personally, I think the equity market can still do quite well. I think the central bank response will be fairly limited. And so we'll be left with a little bit higher inflation. And I think as long as that's not too high, then I think equity markets can do pretty well in that situation.
And someone else asked, given how flat to the floor the policy throttles are right now, fiscal and monetary, we're a long way from even neutral policy, let alone anything that will bring inflation down. How do they do it without killing growth stone dead?
Well, I suppose the thrust of my presentation is that I don't think they will. So I think I would agree with the thrust of the question. I think there has been a huge amount of stimulus. I think they will balk at what they would have to do to really bring inflation down. I think the incentives have changed, and I think they're willing to tolerate higher inflation.
And two property questions for you. I'll mix them into one. Is the property exposure directly held or via REITs? If the former, do you have liquidity concerns? And I suppose an extra question is property ever likely to feature strongly in a portfolio again following recent sell-offs? So 2/3 parts there.
We get our exposure through REITs. Yeah, it's all listed, no direct property exposure. We manage it quite differently to the broader property universe. So, we have our own property fund manager, John Stewart, who's very much looking to find resilient property REITs, so ones that have a good diversification of cash flow, manage themselves conservatively, and will be more resilient than some of the more volatile property names. So I do think it's an important part of the portfolio.
Brilliant. Thank you, Stephen. We've run out of time there, everyone. I've seen there's a few more questions come in, but don't worry. I believe Baillie Gifford will answer those to you probably in an email or something like that privately. So you should definitely get your questions answered, even if I don't have time to ask them here. Thank you again, Stephen, for a great presentation, and of course for answering insights in a pretty lively Q&A session there. Now, before we wrap up, let's just take a quick look at those learning objectives again, if we can get them on the screen. I will recap them anyway whilst they come up. So hopefully Stephen's explained the reasons inflation may be higher for a sustained period, described which investments can provide income growth to combat inflation, and explained the benefits of a global multi-asset approach to deliver reliable long-term income. That's all we have time for today. Thank you for your questions, and thank you again to Stephen for joining me today, and for, of course, letting me and you folks at home grill him with all those questions. As I said before, if a question didn't get answered, Stephen and Baillie Gifford will do their best to do so after the event. And before we close up, I should assure you that your CPD will be delivered tomorrow. Please quickly check the chat function if you haven't got both of your names in your Zoom profile, so we can make sure your CPD gets to you. Otherwise, it'll be very hard for us to do so. Before we sign off, let me just remind you of some dates for your diary in the first quarter of this year. We have a very busy start to the year at Professional Advisor, and there are 3 events here we hope will add value to you and your businesses. Our annual Q1 multi-asset roadshow starts in Harrogate on the 22nd of February at Rudding Park, where you can see presentations from Albanal Street Partners, Church House Investments, HSBC Asset Management, and Simply Biz, plus a couple more sponsors who will be announced in the coming days. On the 23rd, that same roadshow will be in Warrington, and the 24th in Birmingham. The next week will be at Lee Court in Bristol on the 1st of March, finishing up in London on the 2nd. We also have 2 working lunches coming up for you in March, starting with another one again from our friends at Baillie Gifford on the 9th. We'll be publishing details of that in the next few days. And on the 30th of March, we'll have Schroders, who will be discussing the key business issues coming out of their Q1 advisor survey. Those events is a total of 6 hours of CPD for you if you come along or sign on. And looking slightly further ahead, for those of you who can make the journey to London, please put in the 27th of April in your diaries for our flagship conference, PA 360. This is the largest independent management conference for financial advisors in the UK, where we cover everything from retirement, tax and estate planning, investments, regulation, technology, marketing, any business issues, and a host of other things that affect people running a financial advice business. This year, we'll be opening up with a CEO panel where you can hear the views of Daniel Harrison from True Potential, Michelle Golonska from Sesame Bancorp, and Tenet Group's Mark Scanlon. All in all, PA 360 offers 7 hours of CPD. If you're in the north and can't make it down, don't worry. We'll be bringing you our annual PA 360 North conference in October. So that's it for today's session. All that remains is for me to thank Stephen once more for his presentation and answering our questions. But of course, our biggest thanks go to you, our readers, for your company this lunchtime. I trust you found this helpful and worthwhile. If you did, then we'll look forward to seeing you again soon. Goodbye.